Economic issues have frequently caused numerous nations to become heavily indebted. When this happens, they finally meet their doom and enter an uncontrolled economic crisis. There is the current position of the UK's largest tax cuts in 50 years, whereby the pound has fallen to a record low. And there's the optimism that depressed asset prices might soon rebound back to normal, which may not be the case anymore, given the way things are turning out. In today's video, we discuss Ray Dalio's advice on the upcoming recession and how it's inevitable. As much as there are many moving parts in an economy, it is not much of a complicated system. However, the fundamental fact is that a transaction occurs when someone makes a purchase. Purchases made with cash or credit might be made for goods, services, or financial assets. When you spend money on anything, the transaction is complete, and you're not left with any debt. If you use credit to make such a transaction, you have an obligation. Because credit is an obligation to deliver money, much like debt, you must come up with the money. This is what comes with spending. In other words, during such a deal, you paid money for a good service, or probably a kilo of chicken. Demand is best considered in terms of spending. And in conventional economics, according to the founder of Bridgewater Associates, Ray Dalio, it is a mistake to measure it in terms of the number of goods. During a transaction, whenever money or credit is used as a form of payment, what we go through is a credit cycle. As opposed to what is typically assumed, Ray argues that credit can be created out of nothing, rather than through velocity. He further explains in a scenario that, if I go into a store, or I have somebody paint my house and I say, I'm going to pay you later, I've created credit that will count in GDP. It will be an item of production. According to the aforementioned statement, we have a credit cycle, which indicates that there is not much debt. Additionally, you can borrow money if you don't have a lot of debt. Consider that you make $100,000 per year and have no debt. After that, you can borrow $10,000 per year and eventually spend $110,000. Your $110,000 in expenditures is someone else's $110,000 in earnings. The loop then repeats and reinforces itself. In that cycle, debt increases more quickly than income. Since debt cannot continue to grow faster than income indefinitely, a debt cycle results as debt does. What makes this cycle come to an end? When you start to reduce interest rates, it comes to an end. You lower it if the interest rates are too high. It becomes simpler to pay back the debt when interest rates are reduced. Because the monthly costs are lower, it also has the impact of making products less expensive to purchase on credit. This has an impact on assets' present value. So if you lower the interest rate and you own something that generates cash flow, such as real estate, we have a present value effect. It raises assets, which results in wealth and permits more borrowing. As you continue with the cycle of lowering interest rates, you hit the zero mark where you cannot lower interest rates anymore. Then that part of the cycle ends. You reach a stage known as deleveraging at that point. Deleveraging indicates that you are no longer able to increase debt to income. And when that occurs, the cycle starts to go the other way. Ray thinks that people don't do a good job of calculating incrementally what the effects are on demand. Let's say you have a debt growth at 10%, and you go to a 5% debt growth instead. That has a negative effect on growth. He further argued that it is the marginal change from that level produces a negative effect on growth. When banks leverage up at a particular rate and can't leverage up any more than that, or they reduce the rate at which they're leveraging it up, it has the effect of starting a deleveraging. Take, for instance, iconic instances in Europe or Spanish banking systems. Deleveraging at that point means that income and spending are producing a negative feedback loop. What is being birthed is the beginning of a depression. A depression is a phase of deleveraging whereby austerity and debt restructuring are merged. This is because if you have too much debt to service, you would undoubtedly agree that you should take action. There are, however, just a certain amount of alternatives available to you. You can either transfer the debt by moving resources from the rich to the poor. For example, you can have it forwarded from Germany to Spain. That is one method of handling it. The alternative method is to use debt restructuring. Debt restructuring means that you lower the debt burden, in one way or another, to something that you can afford to service because of the income that you produce. Restructuring can take different ways, and one of them is writing down the debt. You reduce the loan, perhaps by half, as that is the amount you can afford to repay. But the problem with this, according to Ray, is that one man's debts are another man's assets. Therefore, when you write it down in half, it has a significant negative impact on wealth. With this, borrowing money is impossible, and restructuring is a challenge. This is an example of a depression in its typical form. Classic cases of depression include the years 1930 to 1922, as well as March of 1933. What was then done to make adjustments was to print money. In the end, they print money during every deleveraging. A central bank can make loan repayments easier by printing money, which entails slipping a fixed amount into circulation each year. Consider the scenario. You write off a debt by 50% to reduce it to a manageable level. That drastically reduces wealth. If the debt has a 10-year term, it is akin to 5% each year for 10 years. If you slip in, i.e. the central bank releases a specific amount of money each year, 5% instead to that person who wants to pay a debt, then they can settle that debt. And it's 5% a year, which is not much of a huge problem anymore, don't you think so? Let me tell you that the best deleveraging are ones in which you have a balance of all things, i.e. a certain amount of austerity, writing down debts and money printing. Ultimately, you have to reduce the debt-to-income ratio. So you'll have a balance of all those three things. The debt write-downs and the austerity are deflationary, while the money printing is inflationary. Being able to balance the three is what Ray calls a beautiful deleveraging. You would look at the debt-to-income ratios during World War II or the United States in the Great Depression and wonder how exactly they came down over time. You should be aware that in each of these situations, the debt-to-income ratio was reduced by attempting to balance the three aforementioned strategies. Money was printed in sufficient quantities that the normal GDP growth rate must be greater than the normal interest rate. Imagine that you have a certain amount of debt and that the cost of debt repayment is a certain amount. If the interest rate on the credit is higher than the nominal GDP rate, it will accumulate unless you continue to make cuts, which will have a negative effect. Therefore, the most crucial factor in deleveraging, as the United States is currently doing, is having enough cash available for printing to achieve a nominal growth rate that is consistently higher than the nominal interest rate. All of them back in 2007, including the IMF, were deleveragings. In 2007, and also currently, the risks that have begun to manifest in the form of GDP declination in 2 consecutive quarters in the US this year, 1.6% in Q1 and minus 0.6% in Q2, are seen to be triggering tighter financial conditions, particularly in the US and major European economies. Unsustainably high rates of debt growth are what were and are still occurring. In regards to this situation, Ray explains that the most common mistake of monetary policy is that it is targeting inflation and growth. While inflation and growth are important, in an actual sense, what it produces is debt. It has to concentrate more attention on the ratio of debt to income growth and the relationship between sustainability and wealth. What happens is that most of the time, buying financial assets often results in a significant increase in debt. That is a more dangerous and worse scenario than inflation. You look at the financial assets and think they will not be able to service that debt. That produces a big problem and is what produced the same issue in 1929, the 1989 issue in Japan, 1990, 2007, and all other similar situations in previous years, which are now happening in 2022. Let's just say 2023 might not be the year of COVID, but it will be just as interesting with global unstable economic conditions. Thanks for watching.